The challenge for a lot of people is actually going to be like, how do you focus on where you can actually move the needle?
We're back. You usually have to wait 2 weeks to hear our voices, but because Washington is vying for the title of the city that never sleeps, we are coming in with a special episode today. But don't worry, this is still the Housing Insiders, the podcast for founders, builders, lenders, and regulators, and anyone who believes that everyone should be well housed. I'm still Jonathan Lawless.
And I'm Jeremy Potter. And this is the smart conversations that you won't hear anywhere else. And we got an executive order from the White House, John. And so we thought, who better than to bring Jeb Mason back to talk about it today?
And just when we do a timely episode with the amazing Kara Ward about what's happening in Congress, the president, within minutes of recording that episode, launched these executive orders. So we are getting back out and talking about what's happening and what this executive order contains.
So if you listened to Jeb's episode with Housing Insiders last time, you already know this. Jeb's a partner at Mindset DC. He is plugged in, based in part on being a former Deputy Assistant Secretary of Treasury, and he knows he's our go-to guy for what's actually going on behind an executive order when it comes out. So I'm looking forward to this conversation.
Jeb, thanks for joining. Great to see you.
Great to see you. Great to be with you.
Let's start with context because probably pretty important around these executive orders. They kind of remind me of some of my relationships in college, on again, off again. We've been hearing about this might happen. And suddenly we eloped in Las Vegas and boom, the executive order is out. And the timing is a little strange. It comes like immediately after the Senate passes a bill that was initially uncontroversial until the president made it much more controversial, pushing a ban on institutional investors. So anyway, give us a sense of the context of this sudden launch of these executive orders. Was that deliberate or is this parallel tracked? What was going on here as the White House was thinking about launching these executive orders?
Yeah, look, I think it may feel sudden to certain people, and I understand the timing questions that people would have, but let's back the lens up for a second. I think the administration came to office knowing that affordability issues broadly in the economy and housing affordabilities in particular were going to be a major focus. In fact, we were saying during the 2024 campaign that whoever won the presidency was likely to have housing be at the center and housing affordability be at the center of their agenda. There are a variety of reasons why I personally think that that's true, but there's a long tail, in essence, I think, to the extraordinary interventions we saw in the economy in response to the pandemic. Housing affordability was already building as an issue long before the pandemic. We've been building fewer homes since the global financial crisis in 07-08 era, and we've been creating households at a rate far faster than we've been building. So, and you guys are super familiar with all those dynamics, but just in Jeb Mason's view, I think, extraordinary fiscal and monetary stimulus we saw in response to the pandemic, not questioning the validity necessarily of extraordinary interventions under those unusual circumstances of the pandemic, but they were going to inevitably exacerbate, I think, what we're already building as very significant housing affordability challenges, widening the gap between the haves and the have-nots, in essence, in the housing economy, and then therefore in wealth generally. And I think this administration came to office concerned not just about those general housing affordability questions, but also a very, I think, refreshing and broad view that, we have seen household formation slow in this country. And that one of the reasons is housing affordability. That is, young people are delaying marriage and having children, in part because they're concerned about their ability to afford a home in which to raise a family. And anyone that's had the second child especially can probably relate to just the space needs, the school district needs, the safety needs that parents feel very acutely once you get to that stage of life. And I think, responsible people that are contemplating creating a family start to think about that early. And so there is a concern that household formation has been delayed. And that has, some very, I think, severe long-term consequences for the country. Beyond just the individual family impacts, which is, and those are fiscal in nature. They may be social and cultural in nature. And I think this administration's been eager to try to tackle housing affordability with all those concerns in mind. And so they really began to work when they first came into office, but one has to appreciate that it takes quite some time to get a new administration fully staffed up. And so I would say by last summer, there were already talks and drafts of a housing affordability executive order being kicked around. It's maybe not as sudden as people might think.
We had heard it was potentially a national crisis, national emergency level at one point, kind of being in that context you were talking, being bantered around. You also hinted at the context being generational, right? People who own homes want them to continue to be valuable. People who don't need to get in homes. And the administration's trying to balance this household formation, community development piece with the economic engine that is housing, with those who already own housing. And then they titled it Promoting Access to Mortgage Credit specifically. So I'm just curious, like, of those three contextual pieces that you mentioned, what is winning out today?
Well, so there were actually two executive orders released at the same time, along with two accompanying fact sheets. So one was on promoting access to mortgage credit. Another was on removing regulatory barriers to affordable home construction. And so I think a lot of this conversation, and you, Jeremy, and Jonathan will both be highly familiar with this, but a lot of this conversation about housing affordability let me put it this way, every housing stakeholder in Washington, knowing that housing affordability is a increasingly salient political issue, has recast whatever their pet policy concern as a housing affordability concern. And so there's been, I think, a need to clarify what exactly we're solving for from a policy standpoint. And I think there's a growing, and has been some consensus for some time, that at its core, the most important issue impacting affordability is the lack of supply. And so there are disagreements about exactly what market segments of supply we need most. But generally speaking, I think nearly all housing stakeholders and economists who study the problem would say, we just need to build more homes. Those can be homes for rental. Those could be homes for ownership. They could be single family detached. They could be attached, duplexes. They could be multifamily buildings. They could be manufactured or modular.
ADUs is good.
ADUs, yeah. And so I think the general consensus is, we need to build more, full stop. This president also was a builder and a real estate developer. And so I don't think that's an idea that's lost on him. But there are also issues with access to mortgage credit. There's issues with the cost of the real estate transaction. There's issues with the cost of mortgage credit, some of which is tied to aggressive re-regulation in the wake of the global financial crisis and Dodd-Frank. The administration, of course, was eager to point the finger at some of those concerns that they feel like could be streamlined in the regulatory sphere. But the removing regulatory barriers to affordable home construction is also a really important part of this. One of the things that happens at a federal level, with which you guys will be familiar, is that, if you have a housing supply problem, one of the things that's a little dissatisfying about that from a federal policy making standpoint, especially from the perspective of any sitting administration, this would be true of a Democratic one as well as a Republican one, is that the levers and dials available to policymakers in the administration are rather limited when it comes to boosting construction and supply, especially doing that quickly. There are some things that are in the legislation before Congress, which are aimed at boosting supply, some other provisions of the existing bill that are still being debated that might actually have, ironically, the wrong way effect on supply. And that's still being hammered out with how the House might respond to what was passed out of the Senate last week. But on the administrative action level, one of the things you see in here is a focus on best practices related to permitting, related to zoning. Potentially, zoning's less prevalent in the executive order as it is in the legislation, but there's some political sensitivities around zoning issues. But you'll see that there's an attempt here to streamline regs to make it easier for housing developers to develop new housing.
I want to note two things. First, just because you mentioned the importance of having space when you have kids, many of our listeners probably can't hear the sound of little kids' voices in the background, which I imagine are yours, being on spring break. So I'm appreciative that you have a home that can house your family while you're on spring break.
Yes, I'm very sorry about that. I am, despite my efforts to get adequate space to get some distance for calls like this, They're ever present, and that's a
It
joy. So.
couldn't be more relevant. I'm
It's perfect.
enjoying it. Yeah.
And then the second point I made, I mean, first of all, the context of this bill, of these EOs is still pretty interesting. The timing, the fact that they come out now, you're right. So there's two. Let's tackle the first one. And a lot of what we want to do on today's episode is just, make sure people are aware of what the changes are and also kind of the implications. So let's start with this deregulation one, because to your point, there's not a lot of levers that the federal government has to encourage supply. And honestly, zoning is a local thing. This president has been very reluctant to criticize localities for zoning, although we see some of that in the legislation. And maybe there's some movement on this, but this sort of goes after a couple of regulations that are federal that might slow down things, namely Clean Water Act, NEPA, historic preservation. Are these things true constraints? Like, is it meaningful that these things are changing? Has the administration heard complaints about this? Or is this an opportunity for them to kind of take a political position against sort of environmental protections or energy policies?
I think it's probably both. I mean, I know that there's been a lot of headlines about the administration putting pressure on builders to build more homes, to complete more units. There's, some misinformation generally out there about how that process really works in terms of builders, especially the high production single family home builders optioning lots. But I think builders generally have provided this administration with a exhaustive list of various federal regulations, and that in their view inhibit construction or raise its costs. And so this is, I think, in direct response to a lot of input that the administration has taken from industry stakeholders over the last few months, that really started to accelerate a little bit, after Thanksgiving, I would say, in terms of refinement into these EOs that have now been released.
We know the administration was berating large builders and others. Part of their response is like, hey, if you want to help, here are the pain in the ass types of regulations that you're in charge of. Get rid of these and we'll build more. Is that sort of how that evolved?
Yeah, I think very, very much so. And I think there has been, a considerable amount of study undertaken by the Council of Economic Advisors, which is really for the uninitiated, a council for the president composed of basically professional economists. And they've been studying since really early last year, I think, all the different red tape, if you will, that stands in the way of additional housing construction. And it wouldn't surprise me if you see a lot more detailed analysis around that as part of the release of the annual economic report of the president, which usually comes in conjunction with the president's budget release, which we should see later this month. So I don't know that chapter will be in there or not, but I know there's been a lot of study there. So, we're talking about, directing the chairman of the Council of Environmental Quality to issue guidance around exclusions under deeper reviews for housing construction. You've got the historical preservation element that you put in there. You've got an order for the federal agencies to provide incentives for state and local governments to adopt regulatory best practices and speed up permitting, curtail green building codes, reduce costly design and building mandates. So there's a number of things, I think, that we may find that the U.S. government has in its toolkit, both carrots and sticks, to pressure state and local governments around their own building codes, around their own, green belts, for instance, which are consciously designed to inhibit suburban development and suburban sprawl, but are also, driving up home costs. And so I think the administration really wants to get at those things substantively. I think they also think it's probably good politics for the administration to be seen pushing on solutions here, and then we'll highlight where the areas of pushback and friction remain.
Jeb, one of the numbers that keeps coming up, HUD Secretary Turner's on different programming talking about this strategy and executive order. And I think the number that I keep hearing is something around $94,000 per house is considered regulatory or considered potentially up for attack. Do you know if this is the type of thing where the administration or we should be thinking about it as just a bottom line, that you pull this out, you make these changes, and there's an actual bottom line change to the list price of a new home? Is that the right way that the administration wants to be thinking about it, and that you think inside the Beltway they're thinking about it?
Well, there's a lot of complex factors, as both of you appreciate, that go into, I think, pricing homes. And, ultimately, there is a fairly tight market for housing right now, which is why we're talking about housing affordability so much, which means that housing producers are to a certain extent price takers in my estimation. That is, their price is ultimately determined by fundamental supply and demand dynamics. But supply is driven in part by whether or not you can build a home at a price in which somebody is willing and able to afford it. And that fits into a whole complicated web of factors, including, who's your exit? I mean, and is there credit available for an owner occupant? One of the things that's being debated in the legislation right now is whether large institutional investors should continue to be able to buy single family homes. Well, if your only exit is to an owner occupant, no one wants to hear this, but the candid reality is that as a builder, you take a considerably more risk then, that if you could build something, that there will in fact be a buyer, because things can happen in the macro economy.
One of the other factors that drives supply and demand balance is interest rates, which were trending in the right direction. We had the administration celebrating some wins on lower mortgage rates, but last I checked, those are heading in the wrong direction again.
Yeah, and I was going to go to interest rates next. So you're right,
Yeah.
Jonathan. I think it's hard to have a conversation about ownership demand without talking about the macro rate environment. And so the administration has taken aggressive steps to try to bring mortgage spreads in through Fannie and Freddie purchases on balance sheet of MBS, and that seems to be working. But the macro environment is not cooperating. Some of that, I think, is temporary, hopefully, knock on wood, associated with the tensions in the Middle East. But there's, let's face it, like fundamentally rates are higher because the fiscal situation in the United States is deteriorating, and that's not that wasn't something that this administration created. It's something that a series of administrations over basically our entire lifetimes have been contributing to. And we're coming up on a not distant future in which Social Security is going to face insolvency, and I'm sure that some element of the 10 years rise is just tied to open questions that investors increasingly have about fiscal solvency in the United States long term.
Yeah, it's not a not a great thing to hear, but I think you're totally right, and it's sort of, again, around the timing of the announcements of these EOs is like the sort of backdrop of, in the middle of a series of events in Iran, like the suddenly rates are going up, gas prices are shooting up, and then we suddenly get a solution to housing at the same time. Anyway, how those messages get across is going to be an interesting thing to watch in the midterms. But before we move to the other aspect, which I think you were alluding to in terms of demand on sort of access to credit, those types of questions, which really is addressed in the second EO. There's another component, which admittedly I don't think I understand very well. So I'd love to really understand what's about, sort of the change to opportunity zones, new market tax credit. Can you talk a little bit about what that is and what it's doing?
Yeah, obviously, opportunity zones were a special tax incentive created in the TCJA tax reform legislation that was passed during the first Trump term. The most recent tax bill moved by reconciliation last year by Republicans expanded opportunity zones. And so this really is an opportunity for the administration, I think, to supercharge the incentives for capital to come into certain geographic designations across the country where are perhaps underdeveloped and there's been underinvestment, and apply those opportunities to the housing supply challenge. New markets tax credit is another area too, where I think the administration's been very focused on the opportunity to really create some leverage for investors in new housing. And so these are among the tools that that the administration has to incentivize additional housing and affordable housing development, and especially in certain targeted geographic designations.
Yeah, money works. If you can get money flowing, we know on the multifamily side it worked for a very long time, and on the single family side we haven't seen that incentive as much. So it is very fascinating to see that shift in this EO from multifamily tax subsidy to single family.
Yeah, I think that's right. And so there's look, the way I would see these EOs together, and this will maybe provide a decent segue to the other one, Jonathan, which is that this is really, I think, the culmination of kind of an all of government, what some people might call an all of government approach to the housing affordability problem. So it really asked all the different agencies. I mean, when you look across the government, you're talking about not just HUD and Treasury, but the Secretary of Energy and the Director of FHFA and the Council of Environmental Quality, and the Advisory Council on Historic Preservation, and the CFPB and the banking regulators, Fed, OCC, FDIC, are all engaged here. So I think what's really remarkable about this is that you got to give some credit to the people that put this together, which is that it took a lot of development to get to this place. I don't think it's just window dressing. I think almost anyone in the administration would acknowledge that there are no silver bullets in the package. And I think anybody that worked in prior administrations on these challenges would recognize there aren't a lot of obvious silver bullets at the federal level. But you add it all up and it could accumulate to actually making a dent in housing affordability and boosting supply and reducing the cost and availability and improving the availability of credit.
So let's take a break from a word from our sponsors. And when we get back, we'll find out why the CFPB still exists.
If you've been following the news, you'll see that Built just made a major announcement. Built has just launched a new version of its award-winning credit card, the Built Card 2.0. Not only does the new card let people earn points on rent without a transaction fee, but it now allows borrowers to earn points on their mortgage. Two things that are important to know. First, you'll never pay a transaction fee when you pay your rent or mortgage on the card, but you're only going to earn points if you use the card on other things. In fact, if you spend as much on other things as you do on your mortgage or rent, you'll actually get 1.25 points for every dollar on your mortgage and rent. Second, and important for us in the mortgage industry, is that the card technically functions like a debit card when it's used to make mortgage or rent payments. So it never uses a credit line. It's like paying with ACH, but earning points. The demand for the new card is off the charts. And that's because for most people, it offers the most amount of value of any card in the industry. And also, don't forget, the card is only a small part of what Built offers. Built manages payments for 1 in 4 apartment buildings and is now connecting with mortgage servicers like UWM to take mortgage payments. For all of these renters and owners, they'll earn points on every payment. And for all of our members, whether or not they have the card, they'll have access to benefits and rewards at tens of thousands of merchants in their neighborhood, like restaurants, fitness centers, pharmacies, and more.
All right, welcome back. Jeb, you mentioned the myriad of agencies now looking at the second of the two executive orders, the one that I was mentioning earlier about mortgage credit, the one that I was obviously leading the witness because it's the one at the top of my mind. One of the things that you said is there's an agenda here that says, please take a look at this, right? The president's asking all of these different agencies across the mortgage ecosystem, please take a look at this, please take a look at this. And I was sort of half joking, but we thought the CFPB might go away entirely, and yet there it is, prominently featured, defending HMDA. We don't have to start with HMDA, but let's start with that rulemaking agenda and under kind of the overarching strategy of this, if there is one. What did you see and what stood out to you as what the administration's trying to do here?
One of the timing questions we asked earlier, I think is partly answered by the fact that the Federal Reserve and the federal banking regulators are about to come forward with a trio of proposals on bank regulatory modernization. This is also known as the process by which we get to Basel III Endgame, which has seemed to have no end over the years that we've been trying to get there. Vice Chair Bowman of the Federal Reserve has already outlined some of what they're going to do. And the first speech she really gave as they were getting close to final on their proposal, which will be out, I think, this Thursday, was putting mortgage right at the center of it. Right. So one of the first things she talked about is trying to improve competition in mortgage. And one of the things that I think this administration has some conviction about, and I think a lot of other stakeholders have conviction about, is that the regulatory pendulum swung quite far in the wake of the global financial crisis. And I think a lot of that was actually appropriate for those of us that lived through that crisis. But it has basically come to the point of being punitive and not really empirically derived in the wake of all the changes that have happened to the mortgage market since then. So there's been a huge evolution in mortgages. First of all, the Dodd-Frank prohibitions on a lot of the product features that were at the center of creating the global crisis are gone. You don't have negative AMs, you don't have balloon payments and things like that. That's banned. You've also had a lot of, I think, micro reforms within the mortgage market ecosystem that makes it a lot healthier. You've got stronger standards for you got much stronger capital requirements for Fannie Mae and Freddie Mac to start with. You've got a much healthier mutual mortgage insurance fund at FHA. I think premiums are more closely tied to performance over the long run. You've got reforms to risk-based pricing for the Fannie and Freddie. You've got the mortgage insurers, which are one of the principal credit counterparties to the GSEs, who have had their capital requirements called PMARs increased. You've got new master agreements with the MIs. So there's been the advent of the CRT market, the credit risk transfer market, which has done a lot to move from a system pre-crisis in which you had a handful of balance sheets that were very highly levered going into the financial crisis to a system where the principal credit risk takers are managers and distributors of credit risk to balance sheets that are better suited to take that risk. So all that's happened. And I think what you're going to see out of the banking regulators later this week is a proposal to move the pendulum back slightly, not go back to pre-crisis, but to make it a little easier, especially for banks and regulated depositories to participate in the mortgage business. So less punitive. You have a more granular treatment of mortgage risk weights on balance sheet. You're likely to lift the cap on the amount of servicing that banks can really do without it being punitive. I think the proposal will invite comment on what would be a more empirically derived risk weight for mortgage servicing assets. It'll invite comment, I think, on how we should treat warehouse lending, how we should treat private credit enhancement, both MI and CRT. I think those are key things that are going to help make the market more competitive for banks and depositories, and that's going to help with credit availability and access. I don't think it's going to precipitate a massive swing from non-banks back to banks in the mortgage origination space. I don't think it's intended to do that. I don't think it probably can do that because there are other reasons why a lot of banks have shunned mortgage production since the global financial crisis, including liability concerns and reputational concerns with that business, especially for lower credit quality borrowers. But in the higher credit quality, lower levered borrowers, I think banks can play a bigger role.
I'm glad you mentioned the banks IMBs, because I mean, surely the beneficiary of the post-crisis regime was the creation of an IMB market and it definitely helped them tremendously. Not that the processes were great, but it just basically made mortgage production not a balance sheet activity, but a manufacturing aspect, and bringing back the potential of the balance sheet, not to mention Fannie and Freddie's, but bank balance sheets, is definitely going to make some change to the mortgage market. I'm curious to get your view, because Jeremy and I have for a long time argued that we've gotten way too conservative. The advent of various forms of technology should have made the mortgage process much less friction, much less cost, not the whatever $18 million it costs to originate a loan, whatever the MBA says. In your opinion, and you work with a lot of clients, like there are a lot of things that are going to be, I guess, reviewed or looked at. Which of the ones are kind of standouts to you in terms of likely to have some major impacts in terms of how we experience getting a mortgage in the next 5 years?
Well, I think that's where the CFPB really comes in. I think interestingly to me, I mean, Jeremy, I think you framed it well, which is there were open questions, I think, last year about whether the CFPB would endure. But fundamentally, the CFPB was a central achievement of the Dodd-Frank Act, or a central blemish, depending on your policy perspective, in that effort of re-regulation. So it's, the CFPB has become a pain in the side for an awful lot of mortgage originators and servicers. And so there are things that can be done to streamline its operations. We've been of the view that CFPB is probably not going away absent a change in law, which we don't see as likely. But it was one of the open questions we had about the CEO going in, was the extent to which the order would actually direct the CFPB to do some things. We think there's a team at CFPB that is ready and interested in doing some things, because if the CFPB, you can't simply turn the lights off at the CFPB, I think, as several senior administration officials have put it. And otherwise, the stakeholders, lenders especially, are saddled with all the existing regs and consumer finance laws without an obvious path to complying with those laws. And so I think what they're aiming to do here that'll be interesting is, especially like maybe expanding qualified mortgage designation for on-balance sheet lending by the depositories, as an example, which can, I think, help with their concerns about liability that I mentioned earlier with originations. The intuition there is, of course, that if you make a loan and it performs for a period of time on balance sheet, you're making this, with your own capital at risk. You have strong incentives to determine their borrower's ability to repay. And if they're able to repay for a fixed period of time, then it's almost self-evident that you underwrote the mortgage in a way that honors the ability to repay requirement in law. And so that's an example. I think there are a lot of servicing reforms that could be made here through Reg X to make servicing less cumbersome for the lenders, make it a little more streamlined, a little bit lower costs. It's not going to be, again, none of these things by themselves are game changers, but they could add up to something. I know that a lot of lenders would like to see CFPB address loan officer compensation rules, and I think that's on the list of things that they could potentially tackle. There's also RESPA reforms and potentially streamlining the process. I think, Jonathan, you framed well what we sense, which is that their technology development in the mortgage space in some ways was perhaps stifled for a decade in the wake of the global financial crisis because companies were fighting fires related to that crisis and the housing collapse. But there's a lot of innovative stuff happening now from a technology standpoint and a lot of opportunity, I think, to move the ball forward. You see in the EOs things that are really overdue, but pushing more e-notes and digital delivery of mortgages. They can streamline processes, again, incremental changes, but to lower the overall cost of mortgages and expand its availability. And I think there's a lot of promise in what they've outlined.
Yeah, that's how I felt too, Jeb. I read it as there was an over-index on small community lenders who needed special treatment. And so a good example would be what you said. If a small community bank makes a loan and they've done the due diligence on the underwriting, can't we assume that's a qualified mortgage just by the nature of the institution and the underwriting that they do? I get that. Expanding that, great. There's also pieces in here that say, why aren't we, essentially reading between the lines and paraphrasing, why aren't we doing digital mortgages yet? Why aren't we delivering appraisals a certain way? Why are we still having wet signatures everywhere? And I thought it was interesting to see the White House issue an EO from things that technologists have been saying forever that lenders won't do. But it comes back, I guess, to this fundamental DNA of what you're talking about, which is IMBs don't have any power to do anything other than sales and marketing. And because of that, they need Fannie and Freddie to tell them it's okay to do stuff. And then they can go out and develop the stuff to do. With banks, it's different, but banks have less of an incentive because of all the reasons you mentioned. Now we're trying to flip those incentives, it sounds like. But the reality is, like, we want community banks doing more mortgages. And I would actually say, kind of like, for some reason, like, I'm not against community banks. I think it's great. They're cornerstones of communities, but also, like, mortgages are commoditized. To John's point earlier, it's a manufacturing process for government money. What is the incentive for a community bank to do it? I don't see it, honestly. Now, I'm glad we're going to have that conversation and figure it out. But to bring back balance sheet lending is really interesting, but these aren't big balance sheets. These are small community banks. Many of them continue to get gobbled up by mid-size and regional banks who are trying to stay competitive too. So there seems to be a conflict here between the technology and where we all agree it should go, which we think would make mortgages more modern and more efficient and promote access to the point of thing, but then also favoring this kind of expanded small balance sheet, which is great, but also doesn't really affect some of the things we're trying to do at the national level. So it's just kind of interesting to see those side by side.
So a couple of things I just push on there, Jeremy, a little bit. I think one, a lot of our IMB friends would probably object to the characterization that all they can do is, market and sales. There's a lot they do from a QC standpoint. I think servicing is way better than it was, pre-crisis, and there have been winners and losers in terms of, but the survivors in the servicing space, many of them are infinitely better. There's a role for IMBs going forward. I think that's clear. I would not make the mistake of reading what the administration is doing here, of suggesting that there's an anti-IMB bias. But there is, like, let's get more, like, if we want to make credit more available and create more competition in mortgage and ultimately a healthier market for MSRs, then you want more people participating. And you want, frankly, you want consumers, aspiring home buyers, to be able to walk into the lender of their choice and be able to get a mortgage if that's what they want to do. Right. And so this was open up more balance sheets. And so it's not just the small banks balance sheets here, although that's a big part of the marquee part of what the Fed's doing. But, like, think even bigger, right? If you get, like, credit enhancement right within the bank capital rules, then you can have a community lender that maintains the consumer relationship that they have, like in Main Street lending relationship that people of old think about, and you can make that mortgage that person, and you can and bank balance sheets who aren't terribly well suited to holding 30-year credit risk on the balance sheet can then potentially shed that risk through like a CRT transaction, for instance, and get capital credit for having shed that risk. Okay, that opens up other balance sheets, not just cash market investors, but if the Fed will do this right, you could get like global reinsurers, diversified reinsurers who don't naturally hold a lot of credit risk today, but where credit risk could be a portion of their balance sheets going forward. So, when you add it all up, it can end up to a lot to get a lot more balance sheets on this. I would also say one other thing, which is that I do think one can read into some of what's in these EOs a little miniature GSE reform. That is putting less pressure on Fannie and Freddie's balance sheets to carry the market going forward. And there is a day, in my view, which we will get to the end of the conservatorships. I know there are some people that think we'll have conservatorships forever. I think that's an anathema to most Republicans. That is almost coming up on 20 years post-crisis. A temporary conservatorship starts to look like a de facto nationalization. And that's not something, I think we talked about that on the previous podcast, but I don't think that's something that sits well with a lot of Republicans going forward. But there are also things that have to be done to make the market more competitive, get more balance sheets involved, to make the world safe for, I think, ultimately the GSEs coming out of conservatorship. And so the alternative is that you're pushing all this risk back onto taxpayers, and that's inherently limited given the fiscal conditions that we talked about earlier.
Right. So if done right, we could actually see a structure where it is banks, community banks, regional banks, and national brand name banks that are doing some innovative things around mortgage credit to produce products that aren't actually available today. And I think that makes this really fascinating, John, from what we talk about all the time, which is, why aren't we trying this data model? Why aren't we trying this model to get more people qualified? Because we now have data sources to match. And you're saying it's going to flip, or it could, if we do it right, and have banks be innovators around
I think
some
banks,
of those
and
things.
don't discount insurers too, both like monoline MI type insurers, but also multi-line property and casualty reinsurers, for instance, who can probably bear some credit risk on their balance sheets, and that's been demonstrated as a highly effective program in the GSE context. And you could expand that to private label issuance, both banks and non-bank issuance.
Yeah, all of this is making me much more excited about the potential that these EOs have for true market change, which we've been, has honestly been so slow for the last 20 years. And everything you're saying, the sort of, I've been sort of a little worried that the push towards bank isn't great. And I think Basel Endgame sort of is indicating that. But I think a lot of what you just shared, Jeb, is making me more optimistic that this really helps across the board. I want to ask, I guess, two-part question. One, really kind of what's to come next. And maybe the first part of the question is like, a lot of the second EO is like, go look at these things, right? It's not like, here are how these things should change. Like, go look at these things. So I imagine, if I were running a government relations firm, it would be a very exciting time for me, because a lot of people are going to try to figure out, like, what's my ask? What do I think should change? How do I get engaged in this conversation? So how do you see, and by the way, some of the timelines, particularly for FHFA, are not multi-year. They're like, do it by the end of the year type of thing. So what do you see as like, how does this sort of get implemented? Like, what are the next steps? How visible will this process be? Because a lot of what this administration does is they tend to like to keep in pretty small groups. How big is the comment period going to be? Who are the major players that are going to really shape the real outcome of what the CEO is suggesting?
Well, it's going to be very idiosyncratic, I think, to the individual sort of initiative. But like, let's just go through some of the key players. We talked about the banking regulators. That's the Fed, the OCC, and the FDIC. Their proposal is going to come out on Thursday. The trio of proposals, I think there'll be a 90-day comment period. Some people probably ask for an extension, but and may or may not get it. I don't know at this stage. But there'll be, I think, a very genuine effort to get empirical evidence to support where they ultimately land those rules as a final rule. One of the other interesting dynamics to pay attention to there that we've been mentioning to clients is that the composition of the Fed board itself could be different by the time you get to a final rule than it is now. So some things that maybe didn't quite make the cut in the proposal could possibly make it into a final rule. And so we really are encouraging clients and prospects that they think carefully about how to address those rules and put themselves in the mind of the regulators that are there now and that could be there at the final rule stage to try to land the plane in a way that's supportive of these mortgage objectives specifically, and then broader objectives for the economy. I think, CFPB is there's a diminished staff, but a very capable staff there and several people who really know this space really well in mortgage. So I think there'll be a series of rulemakings probably coming out of the CFPB. FHFA, of course, has a very dynamic director in Director Pulte, who's been very, very active on social media and in terms of his directives to the enterprises. And I suspect you'll continue to see more of that. I mean, HUD will have a role. There are, a number of things they'll be looking at. So, I think it'll be, again, it's sort of an all of government approach here, which is being painted. And so there'll be a number of different places where there are opportunities to plug in. And you're right, Jonathan, I appreciate the plug. I mean, we are taking a lot of inbound calls right now, both on this and the housing legislation right now. And we're very fortunate as a firm to work with really top rate leaders in the industry, sort of in every part of the ecosystem. I think that gives us some unique perspective on what's coming and what's going to unfold from here. And we're very fortunate to enjoy really good relationships with people in the administration on both sides of the aisle on Capitol Hill. So this is what we exist for, and this is what we love doing. And it is an exciting time because I think they've really done a good job here of casting a really wide net, narrowing down to things that they can think they can make a difference, not leaning too hard on the hope for a single silver bullet, which I think would be a fool's errand and a mistake from a policy standpoint. But again, this can all add up to something if you can execute on it.
And let me just ask a practical question, Jeb. Is there, from your perspective and working across that bridge you just mentioned, there is an opportunity for fintechs and others to actually influence these reports and this agenda? Meaning, is this an opportunity for innovators to participate, comment, get involved in the next 90, 120 days by the end of the year, as John mentioned?
I think there definitely is. I think I would not try to boil the ocean and think about it all as one corpus of work. I mean, I think there are lots of different individual places depending on the company or the other stakeholder where they should plug in. And that's part of why we exist to help people navigate that. But yes, I think between the EOs, plural, and the legislation, which is still being actively considered in Congress, and I think more than likely to pass into law and be signed by the president in the coming weeks, there will be a lot to work on. And I think the challenge for a lot of people is actually going to be like, how do you focus on where you can actually move the needle, and then let the industry or the trades handle the stuff that they can handle and are well suited to handling on their own. So I think where people take this legislation, I mean, I know that's not the central topic today, but there will be a huge regulatory implementation phase related to that. So if it passes in its current form, Treasury is going to be called upon to do something that Treasury doesn't typically do, which is create a number of programs, including a home ownership program, including a built-to-rent program, including some other programs that are built into that legislation. And they're going to need to define the parameters for those. And I think there are a lot of innovative people that probably will have something to say about how they land the plane on those regs that allows them a window of opportunity to then go work with institutional investors or others who want to fit into those exceptions and continue to deploy capital to build new houses, but fit within those exceptions that allow for ownership programs and build to rent.
It's a fantastic view. And, Kara mentioned in our last podcast that Congress is, once done with their supply side agenda, will be focused somewhat on the demand side as well. So a lot happening in Washington as it relates to housing. And Jeb, I cannot tell you how much I appreciate you getting on and articulating so well. And I think in a way made me a whole lot more optimistic about, what we've been waiting for a long time, which is, real change in Washington as it relates to housing. And it feels like we're kind of getting that in a major way. One thing I'm really interested to see, and for those who don't know, on Wednesday, the National Housing Supply Summit, our friends Matt Hoffman and Dennis Steigerwalt are both hosting an event with policymakers and others talking about supply stuff. And I'll be really curious to hear the reaction of folks in the room and on the various panels, like how they're feeling about some of the deregulation on the supply side, but also on the demand side as well. So a lot happening. And again, I just want to thank you, Jeb, for taking time out of your spring break. And I know you got kids in the background there to get back to. So really wanted to say thank you very much for joining us.
Yeah, happy to do it. Really enjoy talking to you guys as always. You're two of the smartest in the business. And so it's always fun to collaborate. And sorry about the background noise, but my kids will be happy to be immortalized through your podcast.
Great to see you, Jeb. Thanks again.
Cheers.
Yeah, we hope everyone had enjoyed these conversations. That's going to do it for this episode. And as usual, we always love to hear from you guys. We've gotten some great input and thoughts from our listeners. So send us emails at podcast@thehousinginsiders.com. And if you like what you hear, we always love it when you leave us a review or, a rating on the various podcast platforms.
And if you haven't subscribed, subscribe and share. We have to say that because it does help us get this podcast out there. And thanks as always to Keenan Chen for the music.